Thank you all for joining today's Financial Crush Friday. My name is Cynthia Boyede, and I am your Mo Money clerk. Our goal here at Mo Money is to help you improve your financial literacy so that you have a strong foundation for your financial future. For more tips and to stay updated, please follow us on Instagram at momoney_mohawk and on Facebook, as well as check out our website, mohawkcollege.ca/momoney. Today, we're joined by Mohawk College professor and certified financial planner, Robert Lysohirka, and he will be talking to us about debt and sharing tips on how to manage debt properly.
Hey, thank you for the introduction, Cynthia. And just a word to all of our students who are joining us today and in the future. Just a bit of a shout out for Mo Money. How I came to learn about Mo Money, a former fellow student of mine, actually from many years ago, had joined up an initiative there that Mohawk had put forward. Mo Money, I find, is an excellent resource for all students. Just providing students with skills necessary for effective money management. How much more can you say? I know what going to school is all about. So before we get started, I'm just going to give you a few words about myself and how I came to be here today, and so that you can kind of relate to me more on a one-on-one side, or more as a friend to you rather than a professor kind of thing. So a little bit about me. Throughout my life, I have done many, many jobs. I've been in construction for many years. I did all kinds of things where I earned all kinds of levels of money. Sometimes I made very little money. Sometimes I made substantial money. I will admit I was not always wonderful at managing my own debt, and that is what today's focus is on. We are doing a segment here on Debt Management 101, which I find is very, very important in not only in your personal life and professional life, but just to have to be able to relax and to maintain some calmness in your life. You have to have your debt under control. So to rewind a little bit there, so as I said, I had done many different careers, and I decided that I wanted to do something that I was going to be able to use my brain, I guess, going forward. So I came to Mohawk as a mature student over 12 years ago, and I was deciding what to take. So I took a program called Financial Services. So that's still offered here at the college. And so I was actually a student not all that long ago here. So I came to Mohawk and I took Financial Services, a 2-year program. I graduated with honors and then pursued my Certified Financial Planner degree. So I am what's considered a Certified Financial Planning Professional still. But what happened after Mohawk was I embarked on about a 10-year career with Investors Group, now known as IG Wealth Management. So through that, I learned a lot of financial planning techniques. And I'm going to say that the number one issue, there were two main issues with just about everybody I ever encountered. And the number one issue was debt mismanagement. So they had a lot of debt and a lot of money coming in, but also a lot of money going out. And it was up to me to initially find out where all of those holes were, because without freed up cash, you can't really focus on your financial future. Incidentally, the second biggest problem was people did not have enough saved for their retirement. But I attribute that directly to that debt mismanagement portion. So that is what is missing in a lot of people's lives. So I'm going to give you today a few tips. I have a PowerPoint presentation I'm going to go through. We have a bit of an agenda. It might seem as though we're drifting off topic, especially initially in the presentation, but I will assure you that there are certain things that need to be cleaned up prior to even exploring debt and borrowing on credit, say, for example. So I'm going to get into that presentation now. I'm just going to share my screen with you. And I don't think I need sound, so I'll just share. And I'm going to go right into my PowerPoint presentation. Again, this is recorded, so you should be able to access this at some point in the future if you're not in on the call today. So I'm going to run it as a slideshow from the beginning. So as I said, we are talking about Debt Management 101 today. So this is Financial Crush Fridays. It's an initiative put forward by Mo Money to give you some webinars to help sort out your financial lives. So that's why I'm here with you today. So just a quick rundown of the agenda we're going to be following today. Again, there'll be a lot of information on the slides, but a lot of what you're going to learn today is going to come from my own personal experiences and what I say and comments I make when we get to those certain slides. So we're going to start off by analyzing your current situation. Very, very important. You can't possibly manage your debt until you know where you stand already. So the only way to find that out is to analyze where you are currently and where you hope to be. And that leads into the second point, setting goals and budgeting. So every successful budget has goals in place and they're within that budget. We will talk more about that as we go in the presentation. Point 3 here is borrowing on credit, which is self-explanatory. Point 4 is sort of an addendum to borrowing on credit, I'll call it. You can't borrow on credit if you don't have a plan in place to repay that debt. So if you're going to go into debt, you have to have a plan to repay it. Otherwise, it will never end. You will always be in that cycle of borrowing and not able to repay. And then point 5 is going to be warning signs of debt mismanagement. So I'm going to give you some warning signs, and I'm going to also give you some problems along with their solutions, and we will talk about that a little bit more detail further on in the presentation. And then I'm going to open it up to questions. So we're just going to, without further ado, we're going to get started here. So we're just going to go through it slide by side. Again, I would ask you to withhold your questions to the end of the presentation, and then by all means, we'll be open for a question period. So the first point I want to address here is analyzing your current situation. So this is where you take stock in where you are right now. Now, in my career, looking at older clients, especially in their 50s, 60s, they had a lot more material to analyze, and it was a lot more difficult. Generally with students and younger people, your situation is quite a bit less complicated. You might not think so because you might feel like you're drowning in debt and you have a real issue, but it's quite often relatively easy enough to analyze and figure out where you are. So the number one step with that is where to begin. And I have always recommended to clients, and when I was in my career and even with my students, I do teach a course at Mohawk called Personal Financial Management, also known as BE 450. I'm going to give a little shameless plug to that course. That is an excellent course. If you are able to pick that up somewhere along in your studies, I would highly recommend taking Personal Financial Management. I have taught it many times, and quite a bit of what I'm going to tell you today is found in that course. It is a lot more detailed course about financial management, but today we're going to focus mainly on debt. So the number one step to finding out where you are today is developing what we call a cash flow statement. So this is not a difficult thing to get a handle on, again, if your situation isn't all that complicated. So the very first step in that is to calculate your total net income for the month. Now this is after taxes. Many of you, if you have a job or have had in the past, you will understand that generally now employers pay you via something called direct deposit, meaning that they deposit an amount to your bank account. Well, if you've checked out your pay stubs in the past, you do realize that you don't get to keep every dollar you make. Unfortunately, I wish that were the case, but it is not. So there are certain deductions taken off your pay, generally income tax, Canada Pension Plan, EI premiums, and so on. There could be other deductions there. However, when we talk about a cash flow statement, we want to focus on what your total net income or take-home pay is, and doing it by the month. So we're looking to calculate that for 1 month and then repeating it again the following month. So step 2 is where it becomes a little more complicated. You must now calculate an accurate list or develop an accurate list of all your monthly expenses. Being accurate is very important in this case. I cannot stress enough that you have to look really deeply into where your expenses are. calculating your net income is relatively easy because if you have a job, you know how much you get direct deposit. Calculating your expenses is more difficult. There are certain things called fixed expenses, which are, say, your rent, your Netflix, whatever it may be. But it's when it comes to that discretionary spending or the money you have a choice whether or not to spend. Those are the expenses that sometimes fall by the wayside. I'll give you a little story about a client of mine one time. I was going over his expenses with him, and it didn't really jive. It didn't really add up. And when I pressed him a little further, he admitted that he went to Tim Hortons on a fairly regular basis. And I said, okay, so I want you to keep all of your receipts from Tim Hortons and we will talk next month, see what happened. When I came back to see him, he had $500 worth of Tim Hortons receipts that he had no idea. He was buying all his crew coffee. He was out on a construction site every day, buying everybody coffee and donuts and on a regular basis. So I said, you know, you're far better off making a cake or something at home and taking it in for your boys, and also buying a coffee maker. They're about $20, and make your own coffee. He did. He cut his Tim Hortons down to about $100 a month. Still too much, but a lot better than $500 a month. But it goes to show money goes out and you have no idea where it is. So you have to really keep an accurate list. I would suggest keeping receipts, especially when you're brand new to this, and finding out just what you spent in a month and make sure you're very accurate. So when you have calculated your total net income for the month, the easy one, and you have developed an accurate list of monthly expenses, the difficult one, you will subtract your expenses from your total income. And what will happen is you will arrive at either a deficit or a surplus. So a surplus means you have money left over at the end of the month. A deficit means you're in the negative. Well, a lot of clients say, well, how's that possible? Well, it is possible to arrive at a negative every month. And what that means is if you're in a negative or if you're in a deficit every month, you're eventually going to be in debt. You're going to be accumulating debt, and it's generally going to be on credit somewhere. It's going to be likely on a credit card. That is not a very healthy habit to get into. So this really helps you decide what are those expenses and are they worth it? So you have to kind of I'm getting a little ahead of myself here, but you have to kind of decide what is very important here and what could I live without. But we will talk about that later today. So step 4 is just simply recording your findings in a monthly spreadsheet. So we are leading up towards something what we call a budget. So what a cash flow statement is, it is a recording of what happened in that month. So how much money did you bring in? How much money went out? And how much money was left, whether it's a positive or negative, and then recording all of those findings on a monthly spreadsheet. Okay, so next slide. So using the data that you have found in your cash flow statement, you can now begin to develop a monthly budget. So a monthly budget is actually a forecast of what is to come. So let's assume you're starting your cash flow statement in October and you've done all of October. Now you want to start a budget in November. On November 1st, you would have a spreadsheet laid out of what you think is going to happen for that month, okay? So that's basically what it is. So you're really forecasting what is to come. Now, is it perfect? Not always, I can tell you for sure. Emergencies come up, things happen. So with that said, you want to ensure that you have put in your budget an emergency fund. So if you don't have an emergency fund, you should really start one right now. With debt management, it really starts to fall apart if you have unforeseen expenses come up. So if there are problems, your car breaks down, you need things for school, that would be a very common one. If you could try to plan ahead for those via having what we call an emergency fund. Now, an emergency fund is something that should amount to at least 3 months of your living expenses. So if it costs you $1,000 a month to live, it's always advisable to have access to cash totaling 3 times that amount. So this means that you could live for 3 months without ever having to go into any kind of debt when we talk about an emergency fund. Now, I know that's difficult, and we will discuss some alternatives here later in the presentation, but it definitely helps you to avoid going into debt due to those unforeseen issues. And believe me, in my career and my life, I have found there are many of those. There are always unforeseen problems coming. Okay, So we're going to move on to setting goals here now. So when you're developing your budget, you have to make some important decisions. So you have done your cash flow statement. You're looking at it and you're saying, okay, I have all my money going out and it's going to these different areas. You really have to focus on deciding what can I do to make my budget work a little bit better for me. So using your cash flow statement, that is what has happened. You can take a look at that and you can analyze and say, what can I get rid of here? What can I do to save money on a regular basis? So if you're, say, dining out too much, I've seen that so much in my career, in my life. I am guilty, believe me. With COVID, unfortunately, COVID is a factor. But one of the benefits, I'm always looking at the bright side, one of the benefits of COVID is I'm eating out a lot less and I'm saving a pile of money by doing that. So we eat in a lot more. So that is one area where you could look at your cash flow statement when you're developing your budget and say, okay, I eat out too much, so I'm going to cut some of that out. Okay. So always focus on making wise choices. Needs versus wants. So needs would include rent. You must have rent. Generally transportation. Not when I was young, but now a cell phone is necessary. It really is. A computer, internet, of course, especially with this online learning we're doing now. Everybody has to have the internet. So there are certain needs, but there's also wants. So we have to look at that and say, okay, well, what is a want here? Like dining out, high-end clothes. Like you have to learn how to make certain decisions and decide what do you need and what do you want, okay? When you're developing a budget, always keep the future in mind. I've always said that, and I mean the distant future. So there's going to be a time where you're going to have to stop working and you're going to have money to live on. So just always keep that in mind. I know when you're a student, that's hard, but there's, as an old wise person, or somebody called the wealthy barber once said, if you save 10% of your income towards your retirement, that's small enough, 10%, you will retire a millionaire. And that is generally true. So I know that sounds ridiculous, but it is true. And I have seen that work. So just keep in mind too, to realize one of your goals. So if you're developing goals to put in your budget, make sure that they are important and that they're not frivolous goals as much as you can possibly do. I don't say don't have fun, but I mean, be careful of where your money's going. But realizing that if you give up a goal, or if you want to realize a goal, you might have to give up something else. So if you want to go on a vacation, you might not be able to dine out for 6 months, be able to afford to go on a vacation. That is something what we call opportunity cost. So you've lost the ability to go out, eat out for 6 months, but now you've gained the ability to go to Mexico for a week or two, right? So just by making that one change. And always know the difference between good debt and bad debt. And we will look at that on the next slide here. So when we're setting goals, keeping in mind good debt. So on the good debt side, student loans, you see that under good debt, and you might be wondering why. Well, I'll tell you why. If you have a student loan, that means you've made a commitment to come to a good school to get a better education, so your future will be brighter. So it is a good reason to take on some debt. Buying a house or a condo, generally always a good investment. Rather expensive anymore and difficult for students to even consider. However, rest assured, houses generally appreciate in value. They go up in value. You will gain a lot of equity in a home generally through your life. Lower interest debt, meaning the interest rate on your debt is lower. We're in a very low interest rate environment and have been for many years. What I mean by that is when you borrow money, the borrower sets a certain rate of interest which they charge you to lend that money to you. And the higher that is, the more money goes to interest versus paying down what you borrowed, okay? What you borrowed is called the principal. What you pay the person to borrow the money is called interest, and interest just flies away. It does not go in your pocket. It doesn't help you in your life or your debt management, okay? Investment loans, so investing in your future by borrowing money to invest, kind of risky strategy there, but it is still a good debt. Versus bad debt, expensive car, that's a big one. So, I always said, Should you have a VW or a BMW? Well, if the BMW is $60,000, $80,000, you're going to be in some rough debt for a long time. And I'll tell you, when you're done, you're going to end up with a used car, and it's not going to be worth near as much as paid for it. So why not a lower end model and still have the same problem at the end of it and pay far less for it? Credit card debt, typically bad debt. I realize you have to do it sometimes. The reason why it's typically bad debt is because it's generally very high interest, in the neighborhood of 19–20%, meaning if you borrow $1,000, you're going to have to pay back $1,200. That's ridiculous. So to me, that's and that's within 1 year, right? So be very careful about credit card debt. It's generally high interest. There's nothing wrong with accumulating credit card debt as long as you have a strategy to pay that back before interest gets too out of control. Other higher interest debt. So if you're at places that charge more money to lend you money, be very wary of that. Again, we're in a fairly low interest rate environment, so it's not so prevalent anymore. But there is some high interest rate out there. Store cards such as Home Depot, generally 29%. So you heard credit card at 19, generally 29 for a store card. Future Shop, Best Buy is going to be 29%. And then payday loans. They charge an exorbitant amount of money to loan you money till the next payday. So it might not seem like a lot of the time, but you're never going to get anywhere if you keep relying on payday loans. Interest rates are very, very important when you consider debt, okay? So it really dictates how long it will take you to pay back that debt. Okay, so while we're on the topic of setting goals, this is something I teach my students, something I've taught my clients, something I follow religiously. Goals should be in SMART format. So there's an acronym, SMART. First off, so let's say we're going to talk about buying a car. Well, that's not very specific. So when we say we're going to buy a car, say we're going to buy a 2018 Honda Civic. You want it to be measurable. We need to know what the cost of that car is going to be. So I'm choosing $12,500. Action oriented. Now we have to start saving a monthly amount so we can buy that car. So you actually divide that by however many months you're going to save, and you start making deposits to your own bank account. Realistic. Here we go. Buying a Honda instead of a BMW. So why would you buy a $50,000, $60,000 car when you're still in school when it's going to put you in an enormous amount of debt? So not a very good one. And time bound. So there has to be an end to a goal. You'll be able to buy the car in 2 years. So versus if your goal was, I want to retire when I'm 60, that's specific. The time is going to be far longer. It's going to be maybe 40 years from now, right? So you have a lot longer time horizon, but you still follow the SMART format. You're very much more likely to get to your goals and achieve them, okay? Okay, so after you have developed your goals and you've analyzed your cash flow statement, you can now put your goals into sustainable monthly budget. So you're trying to develop a realistic budget here, and you want to make sure that you can do this. So never stretch yourself out too thin. By that I mean, if you make $2,000 a month, be careful in setting your goals and your expenses at $2,000 a month, because you'll never have any money left over. Chances are good it will fail. Always keep an accurate record of your monthly income and expenses. This is to ensure that your budget is staying on track. So you want to devise a forecast for the next several months. So if you start now with a cash flow statement for October, you'd want to start setting up a budget for November, December, January, February, and so on, a monthly budget. And then it's always good after one full year to look and see exactly what happened. So what happens with a budget is you have two columns. I'm going to show you on another slide here how a budget looks, or sort of a template of what a budget should look like. So what happens with a budget is you put in two columns. So in your cash flow statement, you're just analyzing what happened in the month before. It's fact. When you're developing a budget, you put what I expect to happen versus what really happened. So the only time you can do that. So assuming your budget is set for November, you will have expected and you will have actual. So you will have two columns. At the end of November, you can go in and input your numbers and see how close they are in reality to what you had forecast. There you can sort of work from there and tweak the budget to maybe make it work for you. This will really help you stay out of debt and keep your debt under control. So very, very important. I know that it seems like we're a bit off topic, but very important to be able to develop a budget and know where you are. So try to also include surprise expenses in odd months, I'll call them. So summer vacation can always surprise you. So let's say you go away every July, your budget is going to look different for July. If you can put in a little extra there for travel, say, September, August, back to school shopping. Holiday time seems to be an expensive time of year. So always realize that their months don't always behave the same when it comes to budgeting, okay? So, and then try to include that. And you'll get better at this, trust me, over the years. And if you can follow a budget, and nobody I know is very successful at debt management if they aren't following a budget. So that's just plain and simple. You have to have something to compare it to. So always be careful to include your carefully chosen goals in your expenses when you're devising a budget. Whether it's a long-term retirement goal, goals are typically short-term, medium-term, and long-term. Short-term would be less than a year, medium-term 1 to 5 years, long-term 5 years plus, right? But always include those goals in there. Some will take a lot longer to get to, some will happen rather quickly, okay? So this is a sample budget here. So just 1 month here would be a cash flow statement. You can see you've got your income up here. So income is not always just standard. It's not just from your job. Sometimes you get student loans. That is income. You've got that money in. And then your expenses. Again, they can change from month to month, but I mean, a lot of your fixed expenses, you're going to know what those are, your utilities, certain things like groceries, sometimes that changes depending on eating habits, different things, gas, say for your car, can change if the price of gas goes up. Right now it's fairly low. Car maintenance, that's one of those things that jumps out to bite you. You don't always know, so it's always good to plan. So what I do, I put $100 a month in for car maintenance. Sometimes I don't use $1 of it, but some months I use 500. Well, I hopefully have enough money already saved in there. Books, computer expenses, and so on. So you take your income, subtract your expenses, and you come up with a net income. So it's either a deficit or a surplus, okay? So that's what a budget should really look like. And you could do 3 here as a student. You could do a monthly budget. You could forecast a semester, and you could do 1 whole year. But you'll have to know what happened in those months before you can do 3 months worth, so you can kind of look back. Okay, so moving on. Okay. So now we're going to get a little bit more into the meat of the topic today, which is debt management. So what happens when you don't have enough cash flow to meet your goals? So this is a scenario that almost everybody encounters. It is, just because you're a student doesn't mean this is unique to you. Trust me, I've had enough clients and enough students over the years to know that this is something that happens to just about everybody, especially if you're going to buy a house. Nobody I've ever known has had enough money to go down and say, here's $500,000, I want to buy that house. Not possible. So there comes a time where you're going to have to borrow money on credit. And this is the root of today's presentation, being debt management. Borrowing on credit leads to debt. It just does. That's just all there is to it. So you have to find a source of additional funds. So sources of credit. Now this, to just give you an example, when you came to school, to Mohawk as a student, I can almost imagine the majority of students would have had to borrow some money to come to school. That's just all there is to it. So again, we talked about good debt versus bad debt. I don't believe that borrowing money to go to school is a bad debt. However, if you don't consider very carefully the place you're going to borrow or the method of borrowing, it could end up being very difficult to repay that debt. So some sources of credit include credit cards. Everybody should know what those are: Visa, MasterCard, and so on. Again, caution about the interest there. Always good to use in a pinch, but never good to rack it up, to max it out, okay? Student loans and OSAP. OSAP is a government mandated loan program that most of you probably know about. Student loans, you can qualify generally for student loans at a bank, say. Generally not too bad interest on them. Personal loans, where you can go to a bank or an institution, could be CIBC, could be BMO, whatever, to borrow money for whatever your needs might be. This could be for a car, it could be for a computer, it could be whatever. They are generally difficult to secure a personal loan because they're generally not. Um, they're generally issued, if you're going to get a good interest rate, they're generally issued by what we call an A lender, which would be a bank, one of the big banks. There's also B lenders out there, which are lesser known finance companies, but they charge a lot more interest. So always, I can't say enough, always know and understand how much interest is going to be on the debt you're going to get into. Whatever the source of credit comes with an interest rate, you must know what your interest rate is. Now, a lot of times people say, what is a good interest rate? That really varies. It depends on what you're borrowing. So if you're borrowing a house, 2-3%, literally. If you're taking a personal loan for your own needs, it could be 6, 8, even 10%. And that could be not too bad when compared to a credit card at 20%. Okay. There's also family loans and gifts. So those are sources of additional funds. There is a difference. Always know that. If you're borrowing money from a family member and they expect you to pay it back with interest, that is a family loan. If they have said, here is money for you to use however you want, and there is no strings attached, that is a gift. It is treated differently by Canada Revenue, which is the collector for taxes in Canada. If a family member loans money, and they're going to charge interest on when you repay, the Canada Revenue Agency wants to know about that. They want to know how much interest you're charging, and it has to follow certain rules. If it's a gift, however, there are no rules. There's nothing to follow here. Okay, so there is a difference. Lines of credit. So these behave a lot like a credit card, but you don't generally actually have a card in hand, and they generally have a better interest rate than a credit card. So this is just somewhere where you've gone to, say, a bank, and they've said, okay, we'll give you access to $5,000. You can spend it any way you want. We're going to expect a minimum payment from you. Here's your interest rate, and go to it. So you can go up to $5,000. So you might charge $1,000 one month. You might pay back $800. You might go back and charge $500. It goes in a cycle, and that is something we call revolving credit, which we'll talk about here shortly. Finance companies, also a source of additional funds. You want to be very careful about interest rates again when you're going outside of well-known banks, say, because they can be quite high on the interest. And payday loans, including places called cash money, very high interest rates. So be very, very careful about borrowing there. Generally consider these bottom two to be quite short-term loans if you ever have to access them. The rest of them can be a little bit longer term. Okay. So when we borrow on credit, so when we're going into debt here, there are generally two types of credit. So there's something called installment credit, and there's something called revolving credit. So installment credit, that is where you're making regular loan payments. For example, your student loan, your car loan, your lease, whatever, where you make the same amount of monthly payment per month, and there is an end in sight. So you might have taken that loan out for 4 years, 5 years, whatever it is, but the interest rate generally doesn't change, and there will be a defined end in sight. You will be done in this many months, okay? Versus revolving credit, this is where credit cards, lines of credit are involved. You're just only required to make a minimum payment or interest only. And there is no defined end in sight because this just keeps going and going. So think about a credit card. You go out and charge that money up, you go into some debt there. You might not be able to pay the full balance at the end of the month, especially if you had a rough month, whatever it may be. But what happens is that balance carries over. So if you don't pay it off in full, you have a new balance at the start of the next month. The problem with this is interest tends to now be charged on interest. So you had a balance from the month before, you let it go to the next month. Now, not only are you being charged interest on the original amount, you're also being charged interest on the interest from the month before. okay? So be very, very careful about letting a balance go on revolving credit for too long. I understand that it has to happen, and I understand that it is a fact of life and that it's a fact of going into debt, but it can be a problem, okay? It can really lead to serious issues. So be very, very careful about that. Always better to have installment credit if you can. If you had to take out a loan, you want to know when it's going to be paid and when you are now released of your obligations for that debt. So your interest rate, again, you've heard me say interest rate 6, 7 times because it is extremely important. It will be crucial in determining how long it's going to take you to repay your debt, regardless of its installment or revolving, okay? And it will generally dictate how much it will cost you to borrow. So a little example there, 1981, this is long before I was borrowing money. But anybody that owned a house and anybody that knows, if you know somebody that was buying a house around that time, they will tell you interest rates for mortgage were 19, 20, 21%. Unbelievable. Now they're 2, 3%. So far, far less. People were unable to stay in their homes because interest rates were so high. Since then, the government's put in place some measures to stop that from happening. But so right now, historically, it costs you very little to borrow money. I'm not saying go into debt, but if you were looking to buy a home, now is the time for sure. I know the prices are high, but you'll pay very little to borrow that money right now, considering historic interest rates. Okay. Okay. So at all costs, if you're borrowing on credit, you have to remember to use credit very wisely. So consider all alternatives before you're choosing to borrow. So before getting into debt, consider, can I buy that with cash? Can I delay that purchase possibly? There are other methods here. Do I really need it? Like, you have to really think things through. And this is where carefully planning your goals comes into play, that you need to understand that there's going to be a time you're going to have to pay that money back, because borrowing now ties up future income later. It just, a funny show I used to watch, the guy said, well, I'll just put it on a credit card, and then when I'm done, I'll just throw the credit card in the river, and all of a sudden the debt's gone. Well, not really, no, because they'll always come after you. And if you don't have a plan in place to repay your debt, before I say that, remember the good debt versus bad debt when you're borrowing. Do you really need to borrow? Always keep that in mind. If you have to borrow money, make sure it's going to a good use, or it's something that's going to help you in your future, in your financial future, okay? And always remember that you have to have a plan for debt repayment in place. When you borrow money, and so if you're getting a credit card and they say, okay, here's your $5,000 limit, your first inclination is, wow, I have $5,000. That's not true. You have the ability to charge up $5,000, but you will always have to pay that back. And again, if you're going to be maxing it out, you're going to have a lot harder time paying it back. So let's take a look at the next point here, debt repayment. So when we talk about borrowing on credit, it's all good if you've got that credit in place and you've got the ability to, attend school, pay your tuition, whatever it may be, buy your Apple computer. You've got all that in place, and now you've got the goods. Now comes the time where you have to think very seriously about, how am I going to repay that debt? So you have to have that debt repayment place and plan before you borrow the money. So don't ever just charge up your credit card and get into so much debt that all of a sudden it's impossible to be able to pay that money back. Because paying your debt back in a timely manner is very, very important to protecting something we call your credit rating. You've probably heard about your credit rating. So this is your credit history. So this there are certain bureaus out there. The people that have lent you money report to these bureaus your habits in repaying that debt on a regular basis. So they do this on a very regular basis. There's a couple of them out there. They're called Equifax, TransUnion. There's certain companies that what their job is to do as a business is to monitor and maintain a credit report on individuals based on their debt repayment history, okay? So very important that you make minimum payments on time every time to ensure good credit history. You must guard your credit rating with your life. I'm telling you, if there's one thing that is going to set you up for a good financial future, you're going to have a good credit history. If you have a poor credit history, it's going to become very difficult for you to borrow money in the future, because no lender is going to pull your credit bureau up and say, wow, you haven't been paying your debts back, so here, I'm going to lend you money. Think about it, right? So always have a plan. If there's ever a time where you've had any difficulty, or COVID's been a real big challenge here, if you're having trouble repaying your debt, make sure you're staying in touch with the people you owe money to. Never, ever hide your head in the sand, because they won't forget that you owe them money, and they'll report to those credit bureaus how poor you are at repaying your money. It's not a crime to have troubles, have debt problems, but it is a problem if you try to hide from them. So just quite often they're very understanding about this. So just always maintain contact. Okay, so when we talk about debt repayment and debt management, you want to make sure that whatever of these debts you've gotten into never exceed 20% of your net income. So we just have a little example here of a net monthly income of $2,000. So $2,000 times 20% would be $400 a month. You should not be putting any more than $400 per month towards those debts that you have accumulated. Now, this doesn't include housing costs, whether you rent or own. Don't factor that in. So don't put that into the 400. This is just those student loans, car loans, credit card debts, and so on. Okay. So just always use that as a rule of thumb. You should never let yourself get over 20% of your net income towards those debt repayments. Okay. Okay. So just a few tips here. We talked about the debt management side of it here. Tips for a higher credit score. So I'm very well aware of how lenders access your credit report and how they can read that. So these are the items that's going to make it better for you. So if you want to increase your credit score, so everybody that has a credit history, they wind up with a score. So different institutions do a different calculation. Generally, you're looking to have your credit score of at least 650. Preferably over 700, sometimes over 800. Generally, the max is 900, depends on who's reporting, but it's in about that range. So think about 700 plus, you would be you would have a very good credit score. Typically then, you go to borrow money, they're going to lend you money because you have a good credit rating, okay? So making regular and timely payments, as I said, so never late with a payment. And if you think you're going to be, contact them first. Don't max out your credit cards. So you don't need to have a whole bunch of credit cards to start with. The ones that you do, you should never have them maxed out, meaning that if you have a $5,000 total limit, you shouldn't be at $4,990. You should try to keep that down to a minimum as much as you can. So be very careful. So it doesn't mean that if you have exhausted one credit card's limit, don't go out and get another credit card. Focus on paying that one back. Staying in touch with creditors in difficult times. I'm telling you, they'll appreciate that a whole lot more than you not being available when they call, okay? And don't carry too many credit cards. For one thing, fraud can happen. For another thing, it looks bad when people look up your credit history. 1 or 2 credit cards at the most should be more than enough, okay? And monitoring your own credit history. So on the debt management side, sometimes things happen. Sometimes people are attacking you and you don't even know it, trying to steal your identity, trying to borrow money in your name, trying to use your credit card. So it's always a good idea to monitor your own credit history. And this does not affect your credit score because it's you looking into it. I personally use Credit Karma. I'm not endorsing them. They've had breaches in the past. Equifax, you can email them for a report or you can mail them. So Credit Karma is just a site where you can get a free credit score and it's quite a summary. If you want a full credit report, you're going to have to pay for it. And it's generally not too expensive. This is different from when you go to apply for credit. They are going to want to look into your credit history and you have to give them permission. You don't have to, but I mean, they can't just look into your credit history unless you have authorized them to do so, because it does affect your credit score slightly, not too bad. But if you can monitor your own credit history without the use of a borrower or lender, it's always good to know where you stand. Okay. Okay, so we're going to move on now to some warning signs and potential solutions to those warning signs. So the top point here, abusing retail therapy. So retail therapy just means you're feeling down, you've had the woes for a while, you're not doing so well in school, let's go shopping. Well, it happens a lot. Sometimes you need to go out if you're looking for winter clothes, say, or whatever. What I would recommend, though, is don't just go out looking around. Always come up with a list of things you actually need, and then go out and then do your shopping and leave when you've bought all of your stuff. I am the worst person ever in a grocery store. I go there and I get everything I went not to get, except for the item I went to get. So that's just what I do. My wife does not let me go grocery shopping because I come home with 16 bags of chips, cookies, whatever, anything that's bad for you, ice cream. And she said, but I sent you to get potatoes. Well, you know what? I forgot the potatoes, but I got everything else. So be very careful. Shop with a list. Next point, too much entertainment. I'm not blind. I know what students are like. I was a student, okay? I've been around the block. I know what entertainment's all about. It's a lot of fun. It's a lot less now that COVID has hit, but you want to be very careful, okay, about entertainment, because if in my career I ever found a glaring hole in people's lives, it was dining out and entertainment. Unbelievable. My own sister, when I analyzed her expenses, $2,000 a month on dining out, just dining out. That wasn't entertainment. That wasn't movies or going to a concert or anything. That was just eating out. Unbelievable. Okay. So too much entertainment, stay home one weekend a month or entertain at home. We're doing a lot more of that lately. And, I'm not saying don't live, but be very careful on where your money's going. Must have name brands and high end. You want Coach, you want Under Armour, you want all the good stuff, Lululemon. Do you really need it? And if you do, can you get it somewhere else, or can you get it at a better deal? We were at an outlet mall a few weeks ago. My wife got a Michael Kors purse and wallet, $150, where it was regularly $500. So while she probably didn't need it, don't tell her, she found a deal. So you can get your name brand and high end, but you can usually get it cheaper. So just shop wisely. Car costing too much. Are you driving a Beamer? Do you really need it? Consider a cheaper car or alternate transportation. Also, shopping around for insurance. Just because now car insurance, I'm well aware, can be a very big expense, especially to a student, because you're younger and they soak you. You really pay a lot more than you should. So just shop around, see where you can get better insurance. I do know that Mohawk has a company that we deal with. I believe it's called Johnson, where we get a group discount with them. So maybe research into that. Maybe try to make a change. If your car insurance is too high, try to see if you can get a better deal. Okay. If you're in overdraft, so overdraft is something banks offer for when you go into a deficit in your bank account. So be very careful about that, though, because they charge you money to do that. It's a very little known fact. People think, oh, that's just a free service. No, they charge you fairly substantial money to keep you from going into overdraft, meaning that you have spent more than what is in your bank account. So if you're you're constantly in overdraft and you're fighting to get out of that hole, just spend less or increase your income. Take up a new shift at work or get a second job, whatever it might be. Try to find a way to stay out of that overdraft pit. Creditors calling. So if you are in debt issues, don't ignore it. Call them back and make arrangements. That's all it takes, is say, you know what, I can't make the minimum payment, but it's 100, I can send you 60. They're not going to say, no, we don't want it. They're going to make a deal with you, and you're going to be able to sustain them until you can get back on your feet. Okay. So barring all of that, sometimes debt becomes a serious issue, and you have to look after it. You have to take care of it right now. So it can be where you have done everything you can, but you still can't seem to pull your way out. Unfortunately, this is very real. I have seen this over and over in my career, and it is nasty. It is not nice. There are some ways to combat this problem, okay? So if you have found yourself in debt overload and you can't possibly get out of it, you might consider something called a consolidation loan. So what this means is, let's say you have 4 credit cards. Each one has a $2,000 balance and you're maxed out. You could potentially approach a lender and say, look, I need a loan, one of those installment loans we talked about, put all of your debts together under one umbrella and make monthly payments until it's gone, okay? Generally, you're in a better interest rate and now you have an end in sight, okay? So that's big, right? That's something I did for a lot of clients over the years, and it's generally quite effective. When it becomes ineffective is when you let it happen again. So if you have done a consolidation loan and you rack up more debt, that can be a big problem. Seek credit counseling. I can't say enough about Mo Money. So that is who's bringing this presentation to you today. They're a great resource. So they are a place where you can go for some assistance, trying to empower you with the skills you need for better debt management and better money management ultimately. As a very last resort, if you've tried everything and nothing works and you have so much debt you can't possibly get out of it, you might seek what we call a consumer proposal or creditor protection, better known as bankruptcy. This is, I will tell you over and over, this is a very last resort. In my career, I never recommended bankruptcy to anybody, and I only recommended a consumer proposal, I think, twice in my whole career. It is drastic. So you talk about your credit score being 700 plus. If you go into a consumer proposal or creditor protection, you're going to be in about 400, and no lender is going to look at you. And that stays with you for a long time. So 6, 7 years stays on your credit history. So be very, very careful. This is dramatic, okay? So just be careful about going that route. Always better to try to do a consolidation loan, try to manage that debt legitimately, okay? I'm not saying consumer proposal or bankruptcy is not legitimate. It is there for protection, but it should be, you must consider the consequences before you get into something like that, okay? Okay, so that's basically it, what I had to talk to you about today. So I'm just going to open the line for questions there. I will stop sharing my screen.
The first question is, does debt expire? And if you haven't paid debt in a long time, will it just go away?
Absolutely not. So now what happens though? So there's a bit of a process there. If you've gotten into debt, you've ignored it for a long time, generally what happens is the original debtor or the original lender it no longer fights anymore. So they write it off as bad debt. However, they sort of sell your debt to a collection agency. So what happens now is a third-party company comes out and they hound you. Like they can get really nasty, and they're looking for you, and they're calling constantly. They're trying to find you, and they're pretty good at it too. Never have I ever known of a debt that has just gone away. It doesn't happen. Now with that, don't forget that all the while you're still being reported to the credit bureaus, and now on your credit history it shows that you're in collections. So that's generally the path that it goes.
If you can't afford to pay off your debt, what should you do?
I would investigate alternatives first, for sure, always. So prior to trying to go into a consumer proposal or to declare bankruptcy, always try to figure out a way to pay that debt. Now, if you can go to a lender to get a personal loan, it could be a situation where you might be able to borrow money from a family member, being careful not to incur even further high interest debt. If you can find a way to consolidate all of that debt in one location, even if you have to pay a little bit higher interest rate, it is better to deal with it. And what really happens then is your credit history starts to repair, because now you're showing that you have been making payments on this debt that has gone on for too long.
If you're a co-signer and the person doesn't pay.
Okay, very good question. Yep, very good question. Now, here's what it is. So if you go in with somebody and you are the co-signer for, say, a student. So let's say a student brings a parent and the parent signs as a co-signer. That parent is now equally liable to pay that debt. So and it's not a terrible thing to go in as a cosigner. What really happens is the lender says, okay, the student didn't have that wonderful credit score. They're pretty new, so they're not able to rate them so well. So what happens is they take a look at the credit score of the cosigner. So they might be able to approve the loan based on that. But what the expectation is, if the student is number one, has to repay the loan. If the student fails to repay the loan, they will immediately go after the cosigner to make the payments, sometimes even the full loan. So what if you're ever going to cosign, what you would definitely ask for is say, I want to receive a duplicate bill every month or a statement to say how the payment history has been going. And before it goes out of control, I want to be informed if the student, say, has stopped making payments. I, as the cosigner, must know because your own credit history could suffer.
How does a debt relief program affect your credit?
Debt relief. So, okay, so that is you know, and I'm going to say I believe that is very much like a consumer proposal. So if you've gone for debt relief, what you're basically doing is saying, okay, I owe $20,000, but I'm going to make a deal with you. I'm going to pay you back $10,000. And that is debt relief. So that basically means that you are not agreeing to pay back what you originally borrowed. That's what I believe it means. And in that case, you would still be under a consumer proposal. You would still be on record as not satisfying your debt. So it could have a dramatic effect on your credit history.
How is debt negotiation different from bankruptcy?
So debt negotiation, so there's two types here really. When we talk about, you know, as I said in the presentation, staying in touch with your creditors, sometimes you are just able to talk to the original creditor and say, okay, I can't pay you the minimum payment because it's too much, but I will make a deal where I will pay half or 3/4 of that minimum payment every month until I get back on my feet. If the original lender says, yeah, that's okay, we can work with that, it's generally a lot more favorable than the other one, which is a consumer proposal. And that is where you have gone and said, okay, we want to negotiate the debt. And that means what I said, you're not paying back the full amount. You're saying, so a consumer proposal is something where you go through a third party. So it could be Hoyes, Michaels, Associates. We've all heard them, 310 debt, whatever it might be. That let's say you owe Bell Canada, or we'll go with Best Buy. You owe Best Buy $5,000, and you have said, I can't pay them back at all. So I'm going to 310 debt, and they are going to contact Best Buy on my behalf, and they're going to make them an offer to say, we're going to pay you $3,000 back. That is a consumer proposal, at which time you will pay 310 debt, and they will pay back Best Buy on your behalf. So it eliminates the phone calls. So you don't get any more harassment from Best Buy, but they are unsatisfied. Although they have accepted your proposal, it's still considered a consumer proposal, meaning that that's going to stay on your record of your credit history for 6 years. A bankruptcy stays on for 7 years. So it's only 1 year less, right? And it can only, the repayment plan can only go over 5 years maximum. So 60 payments.
Okay, that was our last question. Thank you so much again.
Okay. Yeah, so thank you very much, Cynthia. I very much enjoyed. I hope whoever is listening, whoever views the webinar after gets a lot out of it. But I was glad to be able to participate today. So thanks for having me.